Okay, so thank you. Welcome, everyone. So my name is François Goyo. So I work here at the Chicago Fed, and I'm currently the president of the Microfinance Society. So today we're going to have two very exciting lectures by very distinguished academics. And the first lecture is by Ravi Bansal from Duke University. So Ravi doesn't need much of an introduction, I think, in this crowd. So I'm just going to give him the floor now, and the title is Climate Change and Financial Economics. And so you have until 4:30.
Do you know where the slides are kept? She said that she used this ball. Thank you. Okay, so thanks a lot, François, for arranging this on complicated circumstances from North Carolina to Chicago and so on and so forth. So thanks a lot for organizing this. The way this talk is structured is I'm going to talk about climate change and financial economics partly because I think finance has a lot to say about it, and we should try and think about the issues from a financial economics or broadly the kinds of issues that come up in finance and climate change. I want to highlight some of those and talk about the questions in it more than anything else. And then because Amir Yaron is my co-author, he wanted me to also talk about discount rates and yields on equity strips, and we have some new data which we collected for longer strip data. And because that's connected to climate change in terms of discount rates, I'm going to try and integrate that to this. So it's kind of two ideas. One is really about talking about climate change and the questions. We will see over that discount rates come into play, and then towards the end, maybe for like 10 minutes or even less, I'll talk about the empirical evidence, and there's a lot of confusion about what's the evidence on discount rates and all that. So I'll talk about that. So the first paper builds pretty much on this joint work that I have with Donna and Marcelo. And here is the kind of questions we are interested in. Okay, what is the economic cost, if any, of climate change that may happen in the distant future? I think the distant future dimension is really important. Okay, so the way climatologists think about it and tell us how to think about it is that there is some distant effect of temperature, which maybe say 40 to 50 years out. If we don't do anything, which means we just let things run as what is called business as usual, then you would have the accumulation of carbon in the atmosphere, which will then trigger disasters beyond a certain period. That's the narrative there, in terms of how climate change could affect the economy in some sense. So from a finance perspective, or from a financial economics perspective, the fact that it's distant is kind of important. What we're going to focus on is the marginal social cost of carbon, which is a way to think about what is the social value of reducing emissions by a small amount. Okay? So what's the rate of transformation in carbon consumption units if you diminish emissions by a really small amount on the margin? So how should we think about that in terms of these economic models? So we'll talk about that. And then the second half of this paper will focus, or 1/3 of the paper will focus on some of the empirical evidence. So one of the arguments we'll make is that because this is a distant thing, it's very hard to measure that from historical data at a macro level. Okay? We have not seen these disasters. We haven't seen the evidence of this in any clear manner. So we want to use long-dated assets and a rich set of long-dated assets to see if they have any information about these risks that are likely to happen. So we'll use a whole range of equities for which we have reasonable quality data, and these are the most long-lived assets that people kind of have studied. So we use both international and domestic data to try and understand some of the implications of the model that I will set up. Okay? So here is the narrative that I just described. Okay? The economic impact of industrial CO2 emissions: there is more output and consumption in the short run. In the long run, it increases CO2 concentration and more carbon in the atmosphere. It leads to global warming, and it leads to temperature-induced disasters. That's the narrative. That's the way people think about it. Okay? So what we're going to do is we're going to develop kind of a merger of long-run risk and disaster models, where the disasters will happen beyond a tipping point. If temperature were to go beyond a certain level, that triggers disasters down the road, which will calibrate to around, say, 50 years from now. Okay, and so that's the setup. Okay, and then we want to use this setup to try and match a whole range of discount rates in the data. Okay, and because discount rates play an important role in these marginal computations, and I'll try and highlight that in the algebra that I go through, it's kind of important to hit upon that. It's important to get them right, because the whole debate in climate change, I think a little bit too much is only about thinking about riskless discount rates of discounting in the future. Not all of it, but a lot of it. Okay? And then we'll look at forward-looking equity prices to see if there's any information in them to study the impact of temperature and help us think about the marginal social cost of carbon. So one of the ways we are going to do that is we are going to bear upon the model some measurements of the elasticity of wealth to consumption ratio. Okay? Which is something which we can go to the asset markets and try and pick up, okay? Or some information about the market price of climate risk, and impose that on the model to try and learn something about stuff which is very hard to learn about, okay? So we'll try and use some of this information to try and get a better measurement of the social value of decarbonizing of the margin. And that's sort of broad idea that we want to pursue over here. And as you can very well see, it's going to be hard to measure things because we're looking at distant things. We don't have historical data to measure it. But I think equity markets probably provide us like the best hope of measuring something and learning something about climate change. Okay? So as I described, the model is going to be a convex combination of long-run risk and disasters. I'm going to call that LRRT model. They're going to be temperature-driven disasters beyond a tipping point. And that's kind of important, that you have to reach a tipping point before the disasters kick in. Inside the model, what's going to happen is that temperature will be carrying a risk premium. And that's going to be really important. Okay? For driving some of the results, is that temperature is going to be a risk in the model. Okay? And getting that to be quantitatively important is really important, as I will show you, in terms of thinking about climate risk itself. Okay? So we're going to match the discount rates, in a variety of ways, and then we'll hope that along with certain other things we match, which is the elasticity of wealth consumption, temperature, and a few other things, helps us provide a better measure of the social cost of carbon. Okay? As I said, temperature has a negative effect on wealth in the economy, in the way we will set it up. It's a risk, and that's important. That's not the case, as it's kind of well understood to some extent in the literature. That's not the case if you don't deviate from power utility. It's going to be really hard to get power utility, which is what is traditionally used in this literature to make temperature or climate a risk, unless you just stick to the utility. Okay? So that's sort of what the setup is going to be. What are some of the things empirically that we will try and suggest or hint at through the data? Okay. So we're going to use both U.S. equity and global capital markets data to show that low frequency temperature fluctuations have statistically significant impact on valuations, okay, in a negative way, okay, which is going to be consistent with the implications. Temperature is going to carry a positive risk premium. I'll show you some evidence of that. And that the premium has been increasing across time, say roughly over the last 2 to 3 decades. And that's the empirical evidence that we want to build up a case for in the paper. Okay. So, just as an historical background, there is literature. The way people approach climate change is they do what I call a lot of micro studies. You know, how is the tourism industry affected? How is manufacturing affected? A whole range of industries, how they're affected. Then they aggregate that up to an implication for the macroeconomy. And so that's called the integrated assessment models. And we use some of that evidence to try and calibrate some kind of damages, which is so hard to calibrate. That's why we go to this approach of trying to match it to some dimensions that we can learn from long-dated assets. Okay? One of the models that Nordhaus, which is kind of prominently used, like power utility preferences, and I'll highlight what the difference is. Okay, so I'm going to be very brief about this. Pretty much when I see across this room, I know everybody knows this already, so I'm not going to talk about it a whole lot. These are just standard Epstein-Zinn, Krebs, Porteous, Wire preferences. And as a result, by just kind of keep around the different preference, the different elastic substitution, and risk aversion, people kind of know the implications of this model reasonably well by now. And then one result, which is also well known, is the equation that I have over here, which that says that you can write down utility in terms of the wealth to consumption ratio. Okay, and it depends on which parameters, and that's also very standard. Okay? So let me just define what the marginal social cost of carbon is. What are we after? Okay, in some sense. So the marginal social cost of carbon is how is on the margin lifetime utility affected if I reduce emissions by a small amount. Okay? And then you have to convert it back to current consumption units, so I scale it by the lifetime utility if I change current consumption by small. So it's that rate of transformation between these two things, that's the social cost of carbon. And then you can show, or you can derive the result, given the result that I showed you in the previous slide. Essentially what this boils down to is comparing two consumption streams. Okay? One, which is what I would call the business as usual consumption stream. You do nothing. Okay? That's the process of consumption. And then the alternative is you decarbonize it a little bit. Okay? And then you compare the value of these two consumption streams while holding state prices fixed. That's the marginal. And that's like an Alvarez Yarnow result that if you change on the margin, this is kind of an extension of that. If you change things on the margin, you can't change the SDF, but you value the streams. And that's going to give you the social cost of carbon. But the important thing is you need to scale it with the current wealth to consumption ratio as well. So that's going to be the computation that's going to go into this. Okay? And so here's how we will set it up. Okay, and so you have global CO2 emissions, which is ET. Okay? That's determined by consumption output in the economy. It's going to be the exchange economy. We can talk about production. It's going to be the emissions in the economy are determined by the amount of goods and services we produce and by the carbon intensity of consumption. So lambda T determines like technological progress. You can decarbonize the process through productivity gains and how we can do it. So all of that is captured in lambda T, and you can historically see lambda T has gone down. That means we have less carbon per unit output in the data. Okay? And so we just take that as given, and we can extrapolate from there, much like Nordhaus does, to take that as given. That's just a process that will improve things will improve technologically across time. Okay, and so that's the relationship between emissions and consumption. Consumption is output, lambda is the carbon intensity. So under the business as usual scenario, when carbon intensity is exogenous, we kind of match the emissions path that Nordhaus provides. He says these are the best estimates of the business as usual emissions path. Okay, we do nothing. If there's no policy intervention, then this is the path of emissions in millions of metric tons per year. Okay, and we just want to take that as given. Okay, but we have no expertise in figuring out what this is. Okay, so we just take that as given, as that's the expected path that people have in mind if we do not do any intervention. Okay, so now we're going to write down how to translate these emissions into a stock of carbon. Okay? And the stock of carbon is just proportional to the level of temperature. Okay? Temperature is just proportional to the stock of carbon, okay? in most of these models. So I have just eliminated that additional step where I first take the emissions, which is the little et over here, and then there is a very slow process, but with very slow decay. These emissions translate into the stock of carbon, which is then proportional to the level of temperature. That gives rise to this equation over here, that temperature just evolves with emissions. And that parameter chi kind of determines the proportionality between stock of carbon and temperature. Okay, and so that's the setup. Okay? There's some details about the allow for the mean reversion, time varying, and all of that, but that's not good right now. Okay. Okay, so that's the so given that calibration that we do of these things along the Nordhaus specification, this is what the temperature path looks like. What it looks like is going to rise steeply. This is all in the business as usual scenario. Okay, no intervention. Okay. So what it looks like is it's going to go up, and it reaches 2 degrees Celsius, which is viewed as an anomaly of 2 degrees Celsius, which is viewed as a tipping point in about 50 years, between 40 years. Then it's going to go up 50 years. Okay? And then when you kind of see it go up without intervention and come down, is because after a certain point over here, there are no carbon emitting fuels left in the economy. And so that's why it starts to decay at that. Okay, and so that's how this kind of goes up and then comes down. Okay, so that's the path of expected temperature that we're going to calibrate to very much like what Nordhaus does. Okay? And so what I need to now do to compute and think about the marginal benefits of decarbonization is how does it affect the consumption path if I decarbonize on the margin. Okay? And you can do a whole bunch of things with this, but I just written generally for now here. It's basically if you decarbonize, what you need to worry about is how is the whole path of consumption affected if I decarbonize or reduce emissions by 1 unit today. Okay? And that impulse is characterized by this equation over here. It's the partial of consumption to a marginal reduction in emissions today, and then it's going to follow that tau, and then it is going to depend on how many years out, and so on and so forth. Okay, so when I go out and compute the social cost of carbon, I'm going to be computing this object. What's the present value of this perturbation in the consumption strip, in the consumption path that I did by changing emissions by a small amount? Okay, and that's the change in the values holding all state prices. Okay? So that's what we are interested in computing. And you can, of course, write this down as the present value discounting it risk neutrally these benefits, we call them benefits of decarbonization. You can discount them risk neutrally. But there is this covariance piece over there. So And that's really important. Okay? Finance covariance is very important. Okay, so why is that important? Well, because we want to think about, are you saving resources in the high temperature stage or not? Is this decarbonization benefiting you in the worst possible stage of temperature? Okay? And that's the reason that covariance term is super important to get climate to matter. Okay? So if you do this, so the traditional impact or the traditional calibration that people do really focuses on this part, right? And not much attention is paid to this part. Okay? And so one of the things that we want to bring to the table is the fact that we ought to start thinking about prospective changes in temperature as a risk. Okay? And then if we can salvage the economy in those states of the world and save output, well, that's going to enhance the value of that saved output today. Okay? And that will crank up or increase the marginal social cost of carbon. Okay, so I think that's kind of an important dimension. Now, as a practical matter, it's very hard to take simple models, the power utility models, and have the state prices or the marginal substitution in the economy respond to temperature in any meaningful way. You can do it, yes, sure you can do it, but it is not quantitatively produce much of an impact. Okay? And I'll show you that. So you need some magnification which is plausible, okay, to generate enough sensitivity in the stochastic discount factor to temperature risks. Okay? And then you need to think about the elasticity of consumption to temperature, to emissions today. Those two things are really important in terms of thinking about the value of abatement, the value of reducing emissions by a small amount. Okay, and so that's what really makes it into a finance question. As beyond, if you look at the papers of Stern, Nordhaus, and a whole variety of people, it's really about what discount rate should I use, just like deterministic discount rate. Should it be 2%? Should it be 3%? Should it be 1.5%? Again, this is flat. Let me just use that discount rate. Generally, it's flat. And let me compute the present value of damages. Okay, they don't do a marginal computation in every case, but Stern, for the most part, just done present value of damages, which can be a big number, but that's not the social cost of carbon. Okay. Okay. So that's what we need. So what I'm going to do now is we're going to set this tipping point of 2 degrees Celsius. That's the point at which you get impact into disaster. Then I'm going to go a little bit faster. So we're going to just model that. How are we going to model that? So here's the consumption dynamics. Okay? So it's I'm going to entertain models without this X piece, but these are the disasters in the economy which are triggered if temperature reaches 2 degrees Celsius. Okay? Not before that. Okay? And one important thing we do over here, and that's really important to do, is all our disasters are compensated, meaning conditionally demeaning, so they do not alter the long-term expected growth. Because if you start altering the expected growth rate of the economy, then you will be lowering the risk-free rates along the path, and that's going to magnify the effects. Okay? So you want to compensate them to focus exclusively on risk in some sense. So we do not alter the long-term growth rate of the economy in the whole segment. Okay? So we compensate them. It's all about risk. It's all about tails. It's all about higher moments. How does that interact? Okay? So I'm just going to quickly go through it. We modeled through this as a compound Poisson process that's kind of been used in the literature. So all you need, as I said, let me not worry about this. So the other thing I want to mention is the size of the disaster, which is dt over here, is increasing in the level of temperature. Okay? Only if temperature reaches this tipping point, and then the probability of the disaster also increases with the level of temperature. You can see about that. So we will look. So that's the setup. And let me just show you in our calibration, the paper has all the parameters and so on and so forth. Let me just show you what the probability, the average intensity looks like. And you can see over here that till this 2 degrees Celsius, there's no disaster. The probability is 0, and then the probability starts to climb. It goes up with temperature and comes back as we track the path of temperature, and this is the average size. And I want to emphasize our disasters are relatively small. Okay? You can see the scale of it. The biggest disaster is like 5%, 5.5%, 6% in that range. They're not massive. Okay? And so we try to look up the literature on what people think will be the effects of these things. We'll try and be conservative about how we calibrate these things. Some of the things we're going to try and do is match it to the evidence that I'm showing you. So that's the calibration. Yeah. One implication of the model is going to be obviously that if temperature is a risk source, which it will be in this setup, is going to affect utility, it's going to affect marginal utility, and it will carry a premium. And I'll show you that. Okay? So let me just show you. Yeah, I have. Yes. Uri, how much time do I have?
You have 45 minutes.
How much?
45.
35.
45.
45. Okay. So so here's the calibration I'm going to do. Okay. So the main calibration is going to be risk aversion of IES of 1.5. And we're going to match the consumption level and the growth rate paths. Match all the financial market data, the interest rates, equity premiums, a few other things that I will talk about. Okay. And then critically, I'm going to match this. Match the elasticity of equity prices to temperature risks. Okay, I'm going to measure that in the data. Okay. And I'm going to impose that on the model in the sense of calibration, not estimation. Okay. And then match consumption dynamics absent disaster, because that's what we can observe historically.
Clarify, the disaster, is it a level disaster or growth rate disaster?
But it's a growth rate disaster. It's affecting growth rates. So yeah, it's like in the disaster literature, it affects the growth rates in the economy. But I have some comments on that separately. We can talk to you about it. Then we can come back to that.
It's not really obvious what a climate change disaster, or disasters for levels, growth rates, or well,
it's a fair enough point. No, I agree with you. I agree with you. Let me hold on. Okay. But it's a growth rate disaster. So here's the calibration. Okay. So I'm going to go through like 4 specifications to highlight some of the margins that are important for thinking about this. So these are preference parameters, and so we have weighted time preference, risk aversion, intertemporal elasticity substitution. This is what I call the primary model, the long-run risk with disaster model. Then these 3 specifications do not have any long-run risks in them. They just have disasters. Okay? There's no X in it, just disasters. They do have that. And so the point of this is, of these two calibrations, is to highlight the effect of discount rate. So for example, we choose like a low power utility setup with a low risk aversion, less than 1, and high IDS, and the kind of usual case that people work with power utility, which is high risk aversion, low IDS. Okay? And that matters because you can have like very low discount rates, okay, with high enough IES, even with power utility. But I will show you that produces virtually a zero social cost of carbon. Okay? And so it's not only about discounting, it's also about risk. Okay? And that's the point I want to emphasize. Yeah? So, okay. And then the other parameters are kind of consistent with the literature, nothing really dramatically different from what we do. Yeah. So I want to highlight over here in these graphs two things. What is the elasticity of the SDF in the primary model? Okay? So if you think about the elasticity of the SDF over here, it is, you can see high temperature states are bad states in this model. And that comes about naturally because the consumption dynamics have been affected by temperature. But the important point I want to make is the internal structure of the model magnifies that. And the SDF really responds quite a bit to these temperature shocks. Okay? That's point number one. Point number two, this is the elasticity of the wealth to consumption ratio. Okay? So you can see the wealth to consumption ratio and the general wealth declines with an increase in temperature. And this pretty much behaves in a way which is similar to how uncertainty in these long-run risk models behaves. You have an increase in uncertainty, then it depresses asset prices, and this kind of behaves very, very similar to that. So the important takeaway from this slide is that temperature is a risk. Temperature shocks carry a risk premium, okay, in this economy because they affect marginal utility, and that's going to play an important role in much of the quantitative analysis. Okay, now let me show you what happens in. So let me take the high risk aversion case. You can see over here the wealth to consumption ratio actually goes up with temperature. That means it's a good state in the economy. Okay? And that's all being driven by precautionary dimensions inside these models. Okay? It's a good state in the economy. It's cranking up the wealth to consumption ratio. Okay? And then you can still do it with the IID case with disasters, okay? Or the simpler version of the model with disasters without the long-run risk piece in it. And you can see it will do the same thing, but it will really be very small effects, okay, on the wealth consumption ratio. Yes?
Sorry, Ravi, I'm a bit confused because you say a shock to temperature, but so the model, I thought the temperature is endogenous, right? Depends on emissions, which depend on consumption, right? So temperature depends on consumption, right?
The temperature depends on consumption, yes.
Right, so when you say a temperature shock, you mean a shock to consumption?
Well, actually, that's a good question. There are actually two shocks. One is the consumption shock, and the other is the consumption shock. The two shocks in the economy. Okay. So yes, it's basically, you could say it's a two-shock model.
But I mean, if you have high consumption growth, then you have high emissions and high temperature.
Way down the road, yes.
Right. But so then you're saying that the high consumption growth is actually bad. It's actually a bad shock now because it leads to a risk of of disasters.
It increases the probability of disasters, and down the road, it increases the marginal utility on that dimension. It's the elasticity with regard to temperature.
Right.
So it's not the elasticity with regard to consumption itself, it's the elasticity with regard to temperature.
Only consumption, yeah.
So this is the partial of the SDF with regard to temperature. Okay. Okay. So that's the setup we have. Okay, and then with power utility it goes the wrong way, as I said, the wrong way. And then if you had with power utility, you had the high IDS case, it's basically flat. There is no small effect. Okay? And that's because there is no risk in the economy. Okay? And so the response over here will look like virtually flat, not all of the big response. Okay. So let me just show you the output of these models, of these various models, and this will then help us think through a whole bunch of things. Okay. So, as I said, because discount rates and risk play such an important role in the computation of social cost of carbon, and much of the earlier literature has been in assuming a discount rate. Not all of the papers, but most papers, in assuming a discount rate, okay, ignoring risk. And so I think it's kind of important to match them, and that makes a big difference, and let me show you how. So these are the various risk-free rate, the risk premia on the consumption claim, and you can see what's going on over here. With the low risk aversion, this is like really small. With the high risk aversion, this is somewhat higher, but still quite small. This is the one without the long run risk, and you can see that the long run risk magnifies these risks and tends to give you like a somewhat better match to what we historically think of this company. I want to also talk about these consumption strip discount rates. So the 10-year strip has this, the 100-year strip has like 2.4% per annum, and then you can see what's going on over here is the high risk aversion case is really discounting the future a lot. Okay, and that's not surprising at all. Okay. So it's discounting it a lot. Now, the low risk aversion case has low discount rates, but as I will show you, the social cost of carbon, that is virtually zero. Okay? And so it's not only about discount rates. Okay? And that's the point I want to make over here. So this is the social cost of carbon that we compute from these things. So in the main model, it's about $103 in current consumption units. Let me intuitively explain what that means. That's like a tax of 30 cents on per gallon of gas. Okay, and that's what that is. Okay? And then essentially, you can see that with constant relative risk aversion, it's virtually zero. Okay, it's not exactly zero, but it's virtually zero. Okay? And so that's sort of the thing that the object that people focus on, because that tells you how important is climate risk. Okay? This is a summary measure of that. How much does society value a marginal decarbonization today? If values are very high, then there is bigger need for abatement. If it doesn't value it a whole lot, there is far less need for abatement. Okay? And that's sort of the message that goes along with it. Okay? So let me also show you what is the elasticity of bulk consumption to temperature. Okay? And then these are kind of the important thing over here is that I showed you in the graph that these are negative with these long run risk kind of models, and with constant risk aversion, they intuitively and empirically, as I will show you, go the wrong way. It's positive. Okay, so let me now shift for the next few minutes, 10 minutes, 15 minutes, to talking about how we can use this setup to say something beyond what historically people have been able to say about the importance of climate change. And let me give you a sense of this. The way people approach it is they look at like GDP growth rates across countries, okay? And they talk about how that is impacted by changes in climate in various forms, be it rainfall or be it temperature or whatever it is. They study that, right? And I just don't think that that is forward-looking enough to provide us information, meaningful empirical information about the potential impact on climate, okay, of climate. And so I think we need to go to something which is anticipating the future in some meaningful way, okay, or has some impact coming from there. And I think the most rich data that we have is on equities, both across countries and within the US, for example, which can be viewed as being forward-looking. And let's use that information to say something about how important temperature risk is in thinking about the questions of climate change. Okay? So what I'm going to do is, and this is still a work in progress, it's still trying to refine it in more than one way. So we use very standard portfolios, and I know all the sorts of questions that this can raise, but essentially you have the standard, just to keep things simple, 25 move-to-market portfolios, which everybody over here is familiar with, okay? Otherwise it wouldn't be in this society. And so that's statement number one. And then the other thing we use is there are these, NIOSH is like an institution that classifies industries into high heat exposed and low heat exposed, okay? And they are a little bit, they don't give a precise formula, but essentially they categorize industries into these two groups. And we are going to just take their classification as given and just treat them as portfolios, and I'll show you what they are. So one other thing I want to talk about is there are lots of papers talking about the impact of weather, okay, on asset markets. We are not interested in that. We are interested in climate or temperature, low frequency movements, okay? Long run shifts in temperature, not weather shifts itself. So it's much harder to go after that than to focus on weather. So here is, let me just show you some evidence. Okay, first let me just show you, here's what we did. And let me explain this regression. It's almost like a finance 101 regression, which is, so we're just going to look at equity returns, okay? We're going to regress them on the change in temperature, and the superscript K corresponds to how much do I smooth the temperature backwards, okay? If I use like a long window, then I'm really emphasizing more the low frequency movements in temperature as I increase K. Okay, and that's the thing. And then we're not saying that temperature is the only risk, so I'm going to include in it a few other variables which we think are well motivated by theory, like consumption growth rate and the return of the market portfolio. This will correspond to all other risk sources and so on and so forth that which we can interpret, and so we just include those as controls in the regression. We are fine not including it, but I think it's better to show the evidence while including them. Okay, and so what you can see over here is on the x-axis, what I have are the temperature betas, and this is the average returns on these things, on these portfolios. And I'll show you in the next table over here. Pretty much all of the betas, return response to temperature, is negative. Okay, which is exactly what the model says it should be. Okay, so essentially you look at these regressions of returns on changes in temperature, and you'll see pretty much all of them are negative, and they tend to increase more for assets which are more risky or more have high risk premium. That's the way we think about it. Okay? So that's. I was remarkably surprised when I saw that. It's surprising that these behaved this way. It could have been anything, but it was exactly the way we thought it ought to be. Okay? So we did that, and this is the evidence from these 10 industry portfolios, NIOSH categorization. So this is, I'm just taking their categorization, and in the end, I don't have a deep micro model as to what is high heat exposed and what is low heat exposed. But they are legitimate portfolios nevertheless. Okay? And so I use them, and this is what we find. The high heat exposed portfolios, oil, transportation, utilities, mining, which is what they classify, are all significantly negative, and then some of these portfolios like services and retail and all are somewhat less exposed, which is kind of consistent with the evidence that I showed you over here in terms of these negative exposures. Now what I'm going to do is I'm going to use, again, I'm going to go out and compute the market price of risk. Remember what the model says. The model says high temperature is a bad economic state. It's high marginal utility state. Okay, and so what we want is the market price of temperature risk to be negative. Okay? And so when you multiply that with a negative beta, you get a positive premium. Okay, and that's what I mean by saying there is like a positive risk premium for temperature. Okay, that's exactly what the model would predict. Okay, and the dates I have 1 year, 3 year, 5 year. This just corresponds to the K. And how much do I smooth? How much do I smooth temperature? How much do I exaggerate the low frequency? Okay, and what you can see the numbers over here, and you can see that in all of these cases, generally the market price of risk is negative. And we have done the test in N different ways, with bootstraps and this and that, but they're kind of significant at the end of the day, for whatever they're worth. Okay? And I understand all the risks associated with that. But essentially, there is some information, okay, in these vectors and how they write out. Okay? And so we tried one other thing, which is again trying to get at this aspect of the model that as temperature goes up, how bad a state temperature is becomes worse. It becomes worse and worse as temperature goes up. So you should kind of expect locally the market price of risk to increase with temperature. Okay? And so we kind of allow that possibility, and what we find is, so we kind of make it a function, market price of risk a function of the level of temperature. And what we find is that indeed, at least over the last 30 years or so, there has been an increase in the market price of risk after controlling for consumption and market values. Okay. So how much has it gone up? Okay. Has increased roughly by about 50 basis points. That's the number that we have. Okay. Now, this is the graph of it. It's just representing what we estimated from this. Let me talk about moving to cross-country evidence. The nice thing about using the US evidence is that you control for the country, you're not worried about cross-country variation for a whole bunch of other things. So we're going to use a lot of controls and go to cross-country evidence where there is greater cross-sectional heterogeneity in temperature levels. Okay? And so we still focus on the anomaly. First, let me just show you the graph over here. Okay? So the point of this graph is this red line over here is the trend in global temperature. So there is like an aggregated time series across all weather stations. Okay, and when you aggregate that up, they come up with a global temperature series, and that red line corresponds to the trend in that. The blue is like you look at like all the countries' temperature and you extract like the first principal component. Well, that's what it looks like. So it pretty much reflects the global trend, and that's not surprising. Okay, so we have 39 countries. Okay, and what we're going to do is we're going to try and estimate the valuation elasticity to a perturbation, sunny elasticity temperature, basically. Okay? And then in the calibration, I did not emphasize this, we impose this, we make sure that we match this number in that calibration. We tweak or change some of the parameters of the size of the disaster and the probability of the disaster to try and make sure that we match this. So it's some kind of discipline on those numbers. We need more discipline, but at least that's a starting point. So we have fixed effects, we have the local temperature. We also have two global controls. We kind of rely on this evidence of Ravi Bansal, where he kind of shows that if you look at like a whole bunch of portfolios, in terms of the valuations, is dominated by like two principal components. Okay? And so we just call those two principal components as macro components, whatever they are. Okay? And so we know that designed to control for whatever macroeconomic influences globally is going on in these markets. That's what X is. Okay? And then we have that has X in it, and then we also have in our estimation included the paper a whole bunch of local controls like global interest rates and local inflation and local GDP growth rates, whatever. We include all of those variables as well to try and control any local effects that need in terms of mitigation. Okay? So we try and use a pretty comprehensive list of doing this. Okay? And this is what we find. Okay? And so this is the longest, so this is again controlling for how much we smooth temperature, okay? And this is, first you can notice all of these elasticities are negative and they're generally smooth, okay? After all of this. The other thing that we observe over here is that there is bigger sensitivity pretty much in the more recent sample. Okay? So indicating somehow that impact may have increased across. So that's sort of what we take away from this, and we use this to control or calibrate the model. Let me not worry about this. Okay? So let me just try and some of the remainder of the time I've talked about the other paper which is related to this, which is I think we need to study climate change, we need models in which climate significantly is not only affecting cash flows or damages in the economy, but also affects marginal utilities in a significant way. It's a risk source. And once you allow for that, you can focus on how important mitigation is to decarbonization. And that, I think, is an important channel for thinking about why we should be decarbonized. Okay, and then you show a whole bunch of this evidence which nobody had explored in the past of thinking about long-dated assets as providing some information about climate risks. Okay, and trying to now, in this discussion, I talked about all these short-dated and long-dated consumption discount rates, and this. And so let me go to this. Okay, and so in the model, okay, if you saw the model, this is kind of well known, there's nothing new in this. The implied consumption discount rates, returns of consumption strips, that's what you call it, are increasing, and that's kind of true for like a whole range of markets. Okay, and you take pretty much any of these asset pricing models, which are somewhat structural and not just reduced form SPFs. And generally, what you will get is upward sloping thing. Now, I think there is a little bit of confusion, and we tried to kind of clarify that. What triggered this was I was able to get data on. Part of the problem is that a lot of this data is not easily available, okay, on these dividend strips. And so I was able to get like data right up to the last 2004 now, which allowed us to kind of explore this, have a little bit more data depth, and look at it a little bit more carefully. Okay? We also got like data on bid-ask spreads and volume and so on and so forth. I won't talk about all of that, but I'll just talk about bid-ask spreads. Okay? And that kind of goes to some questions about how much can be learned from what I like to call exotic data and exotic facts. Okay? And so let's try and see what this is trying to say. I think so the papers which are listed over here, at least the first one, DBK 2012, suggests or states that the equity strip yields or expected returns have a downward sloping return structure, which is not something which any of these asset pricing models can generate. So that's like a criticism of these models. And then they use, in these two different papers, they use options in one case and they use dividend strip data. I'm going to focus on the dividend strip data because that has longer maturities in it, even though the data is only 15 odd years, but it has longer maturities, and it's a cleaner sort of measurement, at least potential measurement of what the people see. Okay? So one of the things we want to document, the main thing I want to document is 2004 to 2017. If you view that as a reasonable sample, some people may or some people may not, okay, but it's certainly bigger than what others have used in the past. Okay? Then on average, okay, it's unambiguous that the expected returns are increasing with maturity and the yields are increasing with maturity. So it is not downward. I think there's a lot of confusion about this, and we want to just clear that up. Now, there is an alternative claim. The alternative claim is that the return on the short-dated dividend strip is higher than or almost the same as the return on the S&P 500 itself. Okay? What that implies then is that the longer dated strips have to have a lower rate of return because it's a portfolio of all of the consumption strips. Okay? It's actually higher than what the claim is, higher than S&P. What we're going to show is this kind of very hard to support that. I mean, the returns on these strips are very noisy, and number one. And number two, the bid-ask spreads on them are almost of the order of the returns themselves. In some cases, even higher. Okay? And so essentially, when you account for that, to be able to draw any precise inference or reasonable inference about the level of these returns relative to the S&P, say, futures contract, which is super liquid, okay? And there's hardly any issue of bid-ask spread over there, is really hard to make Draw that. Okay, so let me just show you. So this is, we have like US, Euro, and Japan. We haven't really focused on the US for now. So these are the yields, which is the last 12 months of dividends. This is the futures price by maturity. They track on an annual basis. These are some of the equations that go along with it. This is the futures price, which is cost to carry. This is the price of the strip for a dividend that pays out in 12 periods from now. All standard algebra, nothing new. And I'm just roughing that for clarity. And what you can see is that the purple, which is the 7, is generally the highest. Okay, that's the longest maturity yield, and that's the highest. Other than in a recession. And that dimension that it flips in a recession condition, any of these markets can generate. Okay? So essentially, it's pretty easy to take like a long-run risk model and say, okay, you have like an increase in uncertainty that will cause these strips to respond differently and generate like a downward sloping thing. But on average, inside the models, it will be the same is true for a whole range of other models. So I'm not going to say it's special to one particular model or not. Now the blue is the 1 year, which is the shortest maturity, and that's generally at the bottom. Okay? And the point of this is the yield to maturity on this is clearly upward sloping, okay, on average. Okay? If we do this condition on recessions, it's downward sloping, but that's not possible. Okay, so that's it. Okay, so what about returns? Okay. So what we are doing over here is what has been done in the past, which is you use like this is all monthly data. So you're using like the end of the month last, say, price from what data we have, and then what's called last price, and then doing all the computations. All these graphs and all will be pretty similar for the short sample. So let me just talk about what about returns. What if I buy a strip which is 5 years out and sell it 1 month later, 6 months later, whatever. And this is all, I've shown you this graph for the S&P 500, the Brittle line, the Nikkei, and the Euro. Okay? And if you do the computations as previous work is done, it's up on average. Okay? And so on this dimension as well, not surprising given the yields are upward sloping. Okay. What about the standard error on these returns? And this is this. I'm just focusing on the US for now. They're 7,500. Okay? And you can see there are some pretty wide standard errors on these things, on these means. So they're very noisy, and you can send multiple trucks through this, okay, in some sense. So it's very wide in terms of the standard error on these returns. And so making structural statements by relying on such a thing, I think, is a little bit courageous at the very least. Okay? So let me show you one other thing. Okay? So for the shorter sample, which goes from 2009 to now, roughly, somewhere around that, maybe 2010 to now, we also have like bid-ask spreads on these things, okay, on a daily basis. And so we just did the usual thing, just subtract from these returns like some kind of average across all these maturities, the bid-ask spread. The bid-ask spread for longer maturities is somewhat higher than shorter, not surprising at all. And basically you can see it swamps the return just kills it. It's just like big beta spreads, and it makes positive 1.5 to minus 0.5. Okay? So these are like really big beta spreads for those 7 years data that we have on these things. So we did one other thing. We said, okay, let me compute. Let me buy the contract at the buy price, sell it at the sell price, okay? Which potentially is an implementable strategy. Okay? But let me not do it on a monthly basis, because if you really do it on a monthly basis, it will generate negative average returns because those spreads are really big. So let me hold it for 6 months. That's kind of ad hoc, but let's say at least 6 months. Okay? And then incur one transaction cost of the whole thing, in some sense. You can increase the maturity to 1 year, 2 years. That will improve it. That would be really nice. Okay? And so, if you look at this, this is the strip returns that we computed earlier on. This is the beta-ask adjusted strip returns on a 6-month horizon, which is this, and this is the index return for this period, for the S&P 500. Okay? That's way low once you account for this. Okay? And so the message from this is that, in our view, there's a lot of confusion about this. Okay? I want to make 2 other observations. These are, I know many of you have worked on this question in more than one ways. These are dividend strips. You can write down models, and many people have written such models, where the dividend strip structure could be downward sloping, but the consumption, which we really care about, is always upward sloping in these models. Okay? So the macroeconomic risk of discount rate is increasing, whereas the dividend strips, because of whatever other mechanism people have in mind, may fall into the pattern. The point we are trying to make over here is that even for the dividend strips, it is the case that with all the augmented data we now have, and we'll try and make this publicly available at some point, that it's sort of upward sloping, and it is kind of economically consistent with how we think about risk in these economies. I've always personally felt that we understand that, see, we do everything in nominal terms to keep things comparable. We understand that bond returns on treasuries, for example, increase with maturity on average. Okay? And everything is nominal. We don't observe the real things in any clean manner. And so that premium is increasing. And it's kind of very hard for me to economically understand why the premium on what is supposed to be a macroeconomic bet should be increased. Okay? And so that's the reason why I think it's kind of important to put out as much data as we can on these questions. I think making the data available is important. It's an important dimension so that others can explore it as well. And so we can come to, reasonable conclusions. So, that's what happens. This paper will be available. Questions?
So could you explain a bit the difference between your findings and the findings in the previously published papers? And this, is it just that you have different longer sample, or that you have different data on the same sample? Or
no, I think our graphs will coincide with theirs for the overlap. There will be no difference.
So this is just about the 3 or 4.
I think part of it is the length of the sample. Okay? And if you really play up the recession, that would tend to push it down. That's number one. Okay? And we did a few other things in the paper. For example, we sorted on measures of, like, let me compute these slopes conditional on being in a recession or non-recession. Recession, non-recession. And in non-recessions, they are really explode when we show it. Okay? And the recessions, of course, as I pointed out, you will see a downward slope, but that's the really fun. And that's not surprising at all. I find it a little bit troubling to draw a strong inference about longer dated returns based on the fact that the short dated one is higher than the index, and that return is so poorly measured. Okay? And so we're going to rely on like anything goes return, okay, to make an economic statement. Well, that implies that the whole universe is done. That's like a little bit trouble. So I want to get around that as well. Yeah.
You also have in class with the Sharpe ratios?
No. But I mean, these papers were not about that. These were about the level of interest.
I know. I saw
Maybe
one, yeah, that was their more robust, I guess, stylized back.
You know, I mean, once you have, if you, at least to the extent you focus on these assets, I don't want to talk about other assets for now, because I haven't studied it. When you have such wide bid-ask spreads, okay, as you have over here, okay, 2% is the average bid-ask spread, which dominates in some cases the return. Okay, it's I don't know. What do I make of the Sharpe ratio? I mean, you know, like the volatility is not like it's affected by those lack of liquidity in a lot of ways. Okay? So I don't know what to make of that, at least in the context of these assets. I don't know about other assets. So long-term assets are more risky. That's the good. At least the ones that we find some data. And one of my objectives is to try and make this, we got it from a bank and trying to figure out a way to make this publicly available. Okay, and so that would be good if more than a few people can explore it that way. Okay? Yeah.
So in relation to the first paper, we know there's going to be huge variation in how the patient's going to be affected by these temperatures. Property values, I think north of here in Canada might become very fertile with farmland, and then you have islands in the Pacific.
Yeah, I think looking at, I really agree. Thinking about those things through the lens of climate change may be a good thing, and I'm supportive of that. I think there is some issue of is there intervention in the markets? Like we have all insurances which are provided to coastal regions. How do they impact the prices? I don't know. I haven't thought through that, but that worries me to some extent. In some places, there's a lot of government regulation which affects things. So one has to control for that. But I think certainly is a way to think through that and kind of evaluate the question. I have no problems with that.
In the case of the first paper, these elaborate a bit more on why they classified risk as finding to be a high heat exposure or something like that.
Yeah, no, and so what they do is, and this is used in the labor literature as well, which is where we found this paper on this whole classification, was in a paper which looked at the question they were interested in was understanding labor supply decisions, okay, of households, and the sensitivity of that to like temperature fluctuations. Okay? And they kind of showed that when they use this classification, okay, it entirely lines up with the sensitivity being high in those what they call high heat settings. Now, do I have, as I said, a micro model for thinking exactly about how to map temperature into the form and then the risk of the form for oil and for mining? No.
But I do wonder if there is a different interpretation, because mining, if you think of the outlook of mining, if there is a global rise in the temperature, maybe mining will disappear as an industry, not because the temperature is rising, but just because actually we're not going to do mining.
Yeah, but that doesn't mean necessarily that it's a negative variable as that you have negative variable temperature. I mean, the size of the industry might shrink, yeah. But I don't think I'm looking at the size. I agree with you that there's some information in that, and then maybe a regulatory impact on that. That's true. But that doesn't necessarily imply that the response to temperature should be, of the return should be negative if you go through the usual rational expectations.